Hey, I know it says with Art Alvarez on there, but today we've got Art traveling. It doesn't mean he's not going to be with us. He's going to be with us remotely. He is at a conference over in Long Beach, and as he is always on the cutting edge. If there's anybody in the emergency room when it comes to loans, he's got his thumb on the pulse of what's happening. We're going to kind of leverage that today. My name is Jeff Harrison. You're at Mortgage Watch with Art Alvarez of Mortgage Works, where he has the answers and they're on the house. Today, we're going to take a little different track than we normally do. We're going to kind of go through a couple of the slides, but really, I want to dig into Art's knowledge because let's face it, the market has been on fire as far as, hey, the Fed's done this, the rates have done this, housing market. I kind of want to put Art not on the hot seat, but I want to be able to drill down and just use his over 4 decades of knowledge to help you as whether you're buying a home, you're refinancing, hey, maybe you're looking at doing a reverse mortgage or even a home equity loan. What should we know? And so with that, I'd love to bring Art in and let's just jump into it. Hi, Art.
Hi, Jeff. How are you?
Good. Hey, you know what? That's a little different background. Tell us what's going on.
Yeah. I'm here, as you mentioned. I'm here in Long Beach, attending the California Association of Realtors. They call it the Reimagine conference, and of course, it's interesting how they spell Reimagine. R-E is capitalized, Imagine, and of course, R-E Real Estate. I think you can get that. And it's actually a conference. It's a major conference. They actually do these like 3 times a year, where they bring in all the realtor associations throughout the state, all the directors of each association, as well as all the car directors. There's over 6,000 attendees to this conference, wow. Which of course means I'm living the dream. As a mortgage broker, where would I rather be than with 6,000 realtors, right? Since that's one of our primary referral sources. So it's been an interesting week. I'm here as I'm in a new affiliate director seat with the Greater Palm Springs Realtors Association, which is why I'm attending this with some of our board directors. So
I don't want to gloss over that part about you're an affiliate director. It's really unusual for someone who's not a real estate professional to actually hold one of those board seats, isn't it?
Well, yes and no. I'll correct you on that.
Okay.
I certainly would be considered a real estate professional because as a mortgage broker, although in the state of California, there's 2 different licensing schemes to be a mortgage broker. I have a real estate license. I've actually had one since 1986, and I've had a broker's license for many years. And so I am, a real estate professional. And so the idea is I'm a licensed real estate professional, but, my career, I have focused on the mortgage origination side, although I can and do, act as a real estate agent and sell homes from time to time. And I don't know that we've ever covered it on the show, but sometime back after the Great Recession, the crash of 2008, when the mortgage industry basically collapsed, we actually, for a couple of years, primarily sold REO properties. Because obviously at that particular time, that was a growth industry. And so we took advantage of that. And it was people I knew who I used to work with, who worked at a couple of major lenders, banks that were managing REO properties and assignments to real estate agents. And so we did that. So I had that experience in addition to most of my career being involved with loan originations. So.
Wow. Okay, so I didn't know that, and that only adds to the intrigue and the R. It's almost like I'm talking to James Bond 007 here. That many layers. And you know what I'd like to do today, take a little bit different twist, is I want to talk about the first couple of slides that you normally go through, but then we're going to deviate because I've got some questions about this. So if you don't mind, let's start there.
Sure.
Okay, so I'm just going to pull it up, and let's go to the first slide, which is your rate grid.
Yes.
I'd like for you to, kind of take a second and talk about the rate grid, but something I noticed that seemed to jump off the page at me today when I saw it was down near the bottom. But talk us through of what's going on with the rates in the last, and we'll see that in the next slide significantly. It'll be pretty obvious, but talk to us about that.
What's interesting about this rate grid is how it has changed from a week ago. As we all know, because it was probably more anticipated than I've ever seen in my career, the Fed meetings from last week. in the anticipation that the Fed was going to, quote unquote, lower rates. And in fact, what the Fed did last week was the first time they've done this in 4 years, if you can believe it. They didn't lower rates, at least not all rates, but they lowered the Fed funds rate. And it was so widely anticipated, I think, for a couple of reasons. Predominantly because a lot of folks on the real estate side, prospective home buyers, even prospective not prospective homeowners who are looking to refi, were anticipating this action by the Fed because they thought it was going to directly impact and improve long-term mortgages. That mortgage rates were going to go down after the announcement. And of course, the announcement was that they were going to lower the Fed funds rate. It was expected 0.25%. They lowered it by 0.5%. And so, of course, that was considered great news. But here's what happened. And you can see this on our rate grid. A week ago, in fact, up until Tuesday of last week, the day before the meetings, a conforming 30-year fix, we could offer 5.5%. If you look at our rate grid now, it's 5 3/4. So conforming 30-year loans actually have gone up 0.25% since the Fed announcement, not down. And I've got some customers who intentionally did what we call float the rate after we registered their file for loan processing, because they were convinced that after the Fed announcement that they're going to see lower mortgage rates to lock into, and it hasn't happened. Now, conversely, where the benefit has occurred is on the equity lending side. Equity loans, in particular HELOCs, home equity lines of credit, those are generally tied to the prime rate. And the commercial bank prime rate directly correlates to the Fed funds rate. So those who either have a HELOC or are looking to apply for one are now enjoying 0.5% lower rates on HELOCs since the Fed announcement. So there's that divergence in the loan product and rate benefit from the Fed action. Long-term mortgages, we've gotten worse. HELOCs, it's gotten better. And so, people are getting accustomed to that, some in a rather grumpy fashion, and others are, of course, celebrating.
I'm curious about that. It's like, okay, if somebody just looks at rates, they think, okay, rates are rates. They're all controlled by the same thing. Like so many people, like you talked about, they said, hey, they just know in their heart when the Fed announces it's going to cause a rate drop, but it didn't. Right. Why are the home equity lines of credit and the fixed HE loans, why have those dropped, but the others have not? Are they two different sources of determining what rates they are? Yeah, absolutely. The thing to keep in mind is that first mortgages, almost all of the most common programs that are utilized, that's conforming. Well, conforming again for our viewers, that means conforming to the maximum loan limits to the two government-sponsored entities, Fannie Mae and Freddie Mac. So conforming loans, FHA, VA, USDA, all of those loan types, and even actually non-conforming jumbo loans, all of those loan types generally are serving as collateral for securities, for bonds, sometimes called on the conventional side mortgage-backed securities. For FHA, VA, USDA, they call them Ginnie Mae's, Government National Mortgage Association, which buys government loans, government insured or guaranteed loans from lenders and package those to collateralize bonds that are sold in the financial markets. So first mortgages generally are not affected directly, as I said, directly at all by the Fed. It's all about the bond market. So I always tell people, if you're looking for a first mortgage, stop focusing on the Fed. Focus on the bond market, specifically the 10-year Treasury bond. That is absolutely your best barometer to follow, to track. And you can do this day to day, like I do, day to day, all day. And you can, as that yield goes up and down, the pricing of these first mortgages are being affected by that in real time. Now, the equity loans, a whole different ballgame. Equity loans actually with a lot of banks are considered consumer loans, even though they are secured, in particular HELOCs, even though they're secured by your home, by real estate.
but how they're priced is entirely different. It's not as much about bonds at all. It's more about cost of funds. And of course, that's where the Fed funds enters the picture, because Fed funds is a direct index for a bank's cost of funds. That's why the prime rate, the commercial bank prime rate, is directly correlated to the Fed funds rate. And that's why, yeah, if you've got a HELOC, and even those fixed rate seconds are going to be more directly correlated to and more directly affected by the Fed's action. And of course, last week it was half a percent down. And that's why on the equity loan side, we're seeing better rates, whereas on the first mortgage side, they're higher.
Well, before we go to this next slide, because I think that's where people will really see that, oh, I see the difference now. When we're talking about people who have existing HELOCs or HE loans, or in this case could be credit cards or lines of credit, because the rate has dropped. I remember when even a year ago, it seems like the rate was around 9.99, and now it's like at 8.275.
Right.
They're actually going to see a difference in their payment and the rate they pay on their next payment. Is that correct?
Yes and no. If you're a homeowner with an existing HE loan, a fixed rate second,
Yep. Okay.
Those are not going to be affected by the Fed's action last week because they are fixed rate loans. They don't have a feature where they're tied to an index like the prime rate, so that whenever the prime rate changes, in this case it's gone down, that they're going to see their rate go down. So if you've already got a fixed rate loan, then what happened last week doesn't affect you. But if you've got a HELOC, particularly if you got one the last year or two, and with most traditional HELOCs, most of the ones that we've done had the traditional 10-year draw period, and they're tied to prime. You should, by the time you get your next monthly statement, you should be seeing a 0.5% reduction in your interest rate, your note rate, and that will directly affect your monthly payment. It should show as lower. And so, to the extent that the forecasts now are that the Fed's going to continue, I'm a little cautious about it. I would kind of caution folks to be careful here, but it's like the media is portrayed it as, okay, we've finally gotten the first reduction, and now we're on this downhill ski slope, but we're just going to see multiple reductions over the next couple of years, like it's just a given. Well, yes and no. I mean, I wouldn't urge people to just count on that. But that's being said, let's think positive here. The expectation is 2 more Fed meetings are going to occur this year, November, December, and the expectation is they're going to lower the Fed funds rate again. I'm going to say 1/4 each time, so that's another 0.5%. So it's possible by year end, a HELOC borrower, somebody who's already got one, should see now a full 1% improvement in their rate since last week, if that bears out. And then of course 25, the forecasts are we could see as many as 4 Fed funds rate reductions, and that's going to drop you even further. So you already got that HELOC in the last year or 2 years. It's looking, cautiously optimistic. You're going to see some pretty good improvement in rates on that loan for the next year, probably couple years, and obviously that's going to be a good thing for them. So, now, if you're on the fence about getting a HELOC, this might be a good time to look at that, because if that bears true as to the predictions for further reductions in the Fed funds rate, now, may be good timing.
Well, and as you said, and I made an error there, a HE loan is locking that in. That's the beauty about that piece. But a HELOC, a home equity line of credit, if they lock it, or if they take it out today and it goes down, they get the benefit of that whenever it goes down, right? So they don't have to wait for changes.
Right, that's true. Although interestingly, as you know, Jeff, not long ago, we were promoting a new HELOC product that's called Fixed Line. And remember how that worked. This one's a little different. It has a 3-year draw period, not 10. But the unique feature of it is when you get this HELOC, it's a fixed rate loan. So it's not tied to prime. You lock in the rate when you apply for the loan. When the loan closes, your rate is locked in for the duration, just like a HE loan. But the unique feature is, as you pay down the balance, let's say you draw the full amount because you need all that money right away, but as you pay down the balance, even though the rate remains fixed, as you pay down the balance, you can redraw the unused portion during the first 3 years, And what's interesting about that, though, is if you don't draw that unused portion and you're just paying it down, your monthly payment does get recast lower because you've paid down the balance. That is a unique feature for a fixed rate loan. Fixed rate loans don't operate that way normally. So this was a kind of a creative new idea. And these loans generally were offering better rates, at least better starting rates. So now here's the dilemma for a HELOC, for a homeowner who's looking at a HELOC. I can offer a HELOC that's a traditional tied to prime variable rate loan. I can offer this fixed line product where your rate's fixed at the point you get the loan. The fixed line HELOC is probably going to give you a better starting rate than the traditional HELOC. It's going to have a higher starting rate, but here's the dilemma for the homeowner. Which one do you pick? Well, if you believe the predictions that the prime rate is going to go down multiple times in the next 2 years because the Fed's going to keep lowering the Fed funds rate, well, that would suggest that traditional HELOC, even though it starts higher, could end up being lower than if you took the fixed line HELOC at closing, because that will never go down. Your rate's fixed at the time you close. So now when I'm getting HELOC inquiries, I'm showing them both and then trying to be the sounding board with the homeowner about, the what ifs. Do you think rates are going to fall a whole lot? Well, you might want to go with the traditional HELOC, even though the rate starts higher. If you're pessimistic and you don't believe the news and you think rates are going to stay elevated, that fixed line HELOC may be a better choice because you're going to start off with a better rate and you're not thinking the traditional HELOC is going to end up dropping below that and therefore be superior long term. So it's a dilemma. It gives you really something to think about when you're trying to pull that money out.
Well, the cool thing is all they have to do is call you at 760-969-5023 and ask these questions, and you can help walk them through this. As an example, as you just said, just, hey, here's my situation. Which one fits better? And at least they have an option now. So that's good.
Plus the fact I have that other option for those senior homeowners. And of course, no offense to anyone out there listening, I'll define senior as 55 plus. We have that Home Safe Second, which is a really unique product, and we're having very good success with. That's for that 55 plus homeowner. Again, the situation that we see quite often. They own a home, lots of equity in it. They have a mortgage that they're managing okay, low rate because they refied in 2021, but they're having trouble tapping into that equity because maybe their income's not quite what it used to be. They're not meeting the traditional qualifying criteria of meeting a debt ratio and credit score requirements and so forth for a HELOC or HE-loan. With this product, we can get people qualified because they're not qualified on debt ratio, they're qualified on residual income or stated income if they're over 720 credit score, and they can get a good amount of money out of their equity and then use that for whatever they need. In a lot of cases, unfortunately, what we're seeing is some of these senior homeowners need this equity basically to consolidate debt because they've had to tap into credit cards and so forth to help manage their monthly living budget. So it's a great option to get people in more financial stability when you're having some trouble qualifying for these traditional equity loan products.
It's a great time to call Art and get some answers. And especially, as you say, for the Coachella Valley, where we have a lot of senior homeowners, this is a great option for them. Well, Art, I want to go to this next slide, if you will. Let's talk about this. And this really tells a story. So this is a 10-year note we pulled up about, maybe 45 minutes ago. Tell us about this and what's the story behind this?
Well, the story behind this is what I've been telling folks for quite, the last several weeks and couple months. All the conversations I've been having with current borrowers and people who are looking to, get a loan or looking to maybe get into the arena to buy a home. All this anticipation about the Fed and expecting rates to go down after the Fed announcement. Well, this chart tells the story. What we kept trying to explain to people is the way this generally works is that as these Fed meetings approach, and if the probabilities are, if in the Fed futures market, the market has decided or convinced themselves that there's a strong likelihood the Fed's going to take action to lower the Fed funds rate, what happens when that occurs is the market prices that in before the Fed announcement. So that's what we saw. In basically mid-August, right up until the Fed meeting, that was the period when we saw some very significant improvement in bond yields and therefore mortgages. The day before the Fed announcement, this 10-year bond yield wasn't 3.8, it was 3.6. That if you were someone who was timing the market, either to you maybe just opened a purchase escrow and you convinced yourself you needed to wait for the Fed, you should have locked your rate the day before the Fed meeting started. Refi borrower, I've got refi inquiries I've been talking to for literally weeks or even a few months. No, I want to wait until the Fed meeting. And I've been urging them, be careful, be careful. And I reached out to some of them that last week before the Fed meeting when we were getting down to 365, 362, 360. Folks, look at this. You need to take advantage of that. And then, of course, if I was wrong and the Fed reduction in the Fed funds rate did cause the mortgage yields, the bond yields to drop even further, well, if they drop enough, we can renegotiate the rate lock, but at least you protected your upside. Well, instead, these folks who were in escrow or about to start a refi who didn't want to do a rate lock and wanted to wait for the Fed, now they're disappointed. And so when, at least at this point, as we can see, if they decide to lock, they're going to get a worse deal than what they could have had if they did it right before the Fed meeting. So again, I can't stress enough, don't focus on the Fed when you're a mortgage borrower or want to be a mortgage borrower. Focus on the bond market. And of course, the bond market is all about the data points, the labor market statistics, the GDP, the CPI, the PPI, the inflation indices. That's what you need to focus on to try to track where mortgage rates are going, where the bond yields are going, because that really tells the tale as to what your opportunities are going to be.
And that's something you are on top of all time. By the way, I want to warn you, though, if you're watching, folks, and you start tracking this 10-year, it's worse than Facebook or TikTok because it's like you've got it almost on speed to just touch it and see what it is. Yeah, it's interesting to watch this and to see this thing creep up as we have in the last 7 days, Art. It's almost like, you know what? I knew I was going to get the bike for Christmas. So I went ahead and went out and got my helmet, got my gloves, got my, and so when the day came, in this case, the Fed unwrapped the 0.5 discount, I already knew what I was going to get. The excitement was over.
Right.
And I was just left with the expense of all these extra things that I bought. Well, let's kind of shift a little bit. What do you see going forward? Because again, I'm asking you to kind of open up your 4 decades of crystal ball and say, what do you see going forward? Will we see some relaxing? Because I see in this chart, there's some spikes and it drops up, but it never gets back down to that 3.6 level that was last week.
Well, it could, and I think going forward, the two things to really focus on in terms of financial markets and economic data points. It's going to be the inflation numbers and the labor market. So, the excitement about the Fed is behind us. So nobody's thinking about the Fed because it's a ways off. The next Fed meeting is not till the day after the election. So now what comes to the forefront is from week to week, month to month, the economic data points that get released. In fact, I would tell some people, if you want, you can Google U.S. economic calendar and you can pull up a schedule by day of the economic data points that are going to be released. And I use that all the time to kind of track what's going on. And so where we go from here is going to be all about the CPI and PPI, again, the consumer price index, inflation at a retail level, producer price index, inflation at a wholesale level. Part of the reason that the bond yield has creeped up already since the Fed announcement is some in the market, and I think more and more participants in the market are saying, wait a minute, we haven't, the inflation fight is not over. In fact, the most recent numbers show a little bit of a creep up in inflation numbers, not down. If that gets any worse, if we see, the CPI the next time it's released, the PPI or the Fed's favorite, the personal consumption expenditures index, PCE, if we see the next release of those numbers creep up a little, even a 0.1%, this yield could get worse, not better. So it's going to be very important in the next period of time to see what the CPI and PPI and PCE numbers do. We need to see those improve some more before you're going to see this bond yield get much better than where it is now. Same goes for the labor market. If we see labor numbers going forward, unemployment rate, number of new jobs added, claims, initial claims for unemployment benefits, if those numbers don't reflect going forward here in the next few periods, some more softening in the labor market, that's going to be another reason these yields are going to hold up, and you're not going to see much improvement anytime soon. And so that's why that's another example of why don't focus on this one little event of the Fed tweaking this one overnight rate, overnight borrowing rate. There's much more to how these mortgage rates behave and what directions they go than just that one particular isolated decision. So.
It's amazing because you've always said, hey, beware the headlines. And it's amazing how and I'll say the media has whipped up this firestorm around the whole Fed rate cut. And you can see here, it didn't really help. In fact, I want to go to the next slide is like, now that that's happened, Art, how is it, when I say, how is it affecting you? How is it affecting the average person out there thinking, hey, I'm going to buy a house or I'm going to refinance my loan? How is it, give us a kind of a broad overview of how is that affecting them? And what to look forward to?
Yeah, a couple things. I think on the refi side, I think the reaction to the Fed announcement and the reduction in the Fed funds rate and how that didn't help mortgage rates any further as expected, at least in terms of on the first mortgage side, I think and I'm seeing initial signs now that I think it's going to help some of these refi borrowers who were timing the market, which I think we covered recently, was a behavior I hadn't seen in recent times. Most folks, if you could present to them, hey, you can save $200, $300, $400 a month, they just jumped at it. But they weren't thinking long term, like, all right, okay, that's great, but I want 500 or 600 before I sign my name on the dotted line. Well, I think now with this plateau, and of course, by the way, contrary to what the media keeps saying, and I just read another news article this morning about rates are way down. It's now at 6.15. Sorry, folks, look at our rate grid. We're in the fives. So I think this plateau in rates after the big Fed announcement, all that anticipation is getting some people off the fence now going, okay, I took a bet. I was wrong. Rates got a little worse, not better, but not so much worse that it's not viable to do the refi. I better go ahead and do it now. I learned my lesson. So we're starting to see some of that. And then on the purchase side, I think same thing. I think what I think we're going to start seeing, and I've seen a little bit of evidence of this, those on the fence about buying, thinking rates were still too high, they wanted to wait for lower. Now that they're seeing the stabilization that has occurred and this little bit of an upcreep, we're starting to see a little bit more activity. I'm doing more pre-quals for purchases. I'm hearing from agents that they're very positive about as we go into the fall period, that they're expecting more activity. By the way, folks, there's more inventory on the market. It's not totally back to normal yet, but inventory has gotten better, certainly in my direct market in Coachella Valley, but I think other parts of California, because we do loans all over the state, you're starting to see more inventory. Now, has that caused home prices to drop? No, but home prices are plateauing as well, softening in a few isolated markets. I think given all that, rates have plateaued at a nice level. Inventory is greater now. You have more options to negotiate a deal in terms of concessions, or our favorite, as you know, Jeff, temporary buy downs, which, by the way, folks, with these rates that we have, if you can negotiate a 3-2-1 buy down in purchasing a home and you need an FHA loan, which is probably my favorite loan product, I mean, you can get a first year rate at, 2 and a quarter. Wow. 2 and a quarter, 3 and a quarter, 4 and a quarter with a note rate of 5 and a quarter, or a conventional loan, 3-2-1 buy down, you're going to have a first year rate at 2 7/8. I mean, if you're a home buyer, now granted, it's not there for 30 years, but you've got that 3-year window to enjoy a very low rate, a much better payment schedule for the first 3 years that gets you into the home. So you're marrying the home, as we say, you're dating that interest rate, and you've got that 3-year window that once rates really start falling even more, hopefully after the inflation numbers get even more under control and so forth, then you've got the best of both worlds. Then you can refinance into a lower note rate. So I don't know. I all of these conditions combined, and I know it's kind of a stereotype. Now's the best time to buy. Since the last couple of years, we really are in a period where this is a tremendous opportunity to get off the fence and get out there, kick the tires. We can help you in terms of negotiating some financial terms with these buy downs and so forth. Get with an agent, get out there and take advantage of what's there, because this really truly is a very good time to look to buy a house.
Well, Art, it feels like, if someone's listening to just this segment, this is like almost getting an insider tip to say, hey, if you have $1,000, I know about this company called Microsoft.
Yeah.
To invest in that. Because here's what as you're rolling this out, I'm thinking, okay, wait a second. You're saying the inventory levels are a little bit higher. They're starting to get, they're not peaking or anything, but there's a good source of inventory out there. The rates have now stabilized and come down. And now is the time to get out there, because if you say, well, let's wait another 3 months. Now, if let's say buyers do come back into the market, what's that going to do? That's going to make it harder for you to get a deal. Because I was looking at some things from a real estate agent, sent me some stuff today. I'm kind of on his newsletter, and he sent me 11 new updates. 8 of those had price reductions on there where that temporary buy down would have been absolutely perfect to ask for seller concessions. That the opportunities are there, gang.
Exactly right. Exactly right. That's the point. Home prices are still going up, but they're going up at a lesser rate, a slowing rate, but they're still going up. And frankly, the amount they're going up now is kind of normal. I think year over year, we're about a 4.5%, 5% improvement in home values from the previous year. That's why the conforming limit went up for 2025 by about 4%, 4.5%. That's a reflection of home values and how much they've increased over the last 12 months.
Wow. Well, Art, before I let you go, I do want to take just a second, because you're at this event you were talking about. Any takeaways that you've noted that you want to share with people out there that maybe are not aware of, some of the things going on? I'm going to say more on that high level that you're associated with right now that they should take note of.
Well, one thing I would say, and this is particularly focusing on the prospective home buyer. The home buyers out there who are thinking about buying a home may be a little fearful of the new NAR, National Association of Realtors settlement, the lawsuit about commissions and how they're paid. And, the outcome of that was, I think, a good thing in the long term. And that's something that's been discussed here at this conference quite a bit. In the old days, you're a seller, you would negotiate a listing agreement with an agent and hire them to sell your house. And you would negotiate with that agent how much you were going to pay them. But on the buyer side, that's never been true. The buyer's agent commission, the agent representing the buyer, their commission was actually already predetermined by that listing agreement, where the listing agent gets the seller to agree to a number that they're going to split with the buyer's agent. Well, when you think about it, that's really not logical. And so the outcome of this settlement and the new rules and all the new forms have created a situation now where the buyer's agent and the buyer need to talk to each other and come to an agreement and put it in writing. The part that's got everybody scared, frankly, was, and especially for buyers, is like they're not being confronted with, here's a contract I want you to sign. I'm going to represent you as your agent, as a buyer's agent. And right here on this form, I've indicated how much I want to be paid a commission that you're going to pay. And, the typical number these days is 2.5% to 3%. That's scaring some buyers. And they're afraid to sign it because they're like, wait a minute. I mean, I'm struggling to come up with a down payment. Now you want me to pay 3% of my offer price to pay you to represent me? And it's not that they don't believe that they are entitled to that kind of compensation, but just the amount is scaring them. What we're learning at this conference, and the general counsel for California Association of Realtors made it actually quite simple, and I'm already seeing this in purchase contracts. What the outcome really should be thought of in a very simple way is, yes, you're going to negotiate with an agent you want to retain as your representative, as a buyer's agent representing you as a buyer. Yes, you're going to be confronted with a piece of paper where you're going to agree to pay a commission amount to them. But that doesn't mean you're actually going to pay it. The next step is when you go out there, look at homes, and you decide on a home you want to make an offer to, then in your offer, simply ask the seller to pay that buyer's agent commission that you agreed to in that contract with your agent. And if you think about it, that's how it always has been. The difference is you're getting it up front, putting it on the table up front. And as his name's Gov Hutchinson, as Gov said in his remarks today, he said, look, all you have to do is make an offer that's sufficient to induce the seller to say, okay, sure, I'll pay your buyer's agent commission because you're offering me a high enough price. Why wouldn't I do that? And if you think about it, that mirrors what has always been done. The difference is it's gotten it up front on the table in writing so that the listing agent has an agreement with the seller. The buyer has a buyer's agent buyer's agent contract with the buyer's agent in writing. So it's in writing on both sides. And then you just got to negotiate a price so that if you don't want to pay that commission to your buyer's agent, get the seller to do it. It's all about the price you offer. It's that simple.
Sounds like it's just, I'm sorry, it sounds like it's just taking it from being an assumed to just, hey, just making it clear.
Exactly. And every contract I've seen that I'm handling right now, that's what has happened. They simply made an offer at a price level where the seller said, sure, we'll pay it. I'm not handling any purchases yet where the buyer's actually paying the commission that they agreed to their agent because they simply negotiated an offer price that was sufficient for the seller to say, great, I'm getting my net that I wanted anyway. So why wouldn't I do this? I want to sell my house and move on. So,
yeah.
So that's the thing. And I would just urge buyers, don't be afraid of that. Again, this is not a reason not to get out there, kick the tires, and try to make a deal. You will probably not have to pay that buyer's agent commission, even though you have a piece of paper that shows that you agreed to do that.
And I suspect the agents that are representing those buyers are probably educating them on that process so it takes down the fear, or are they able to do that?
Yeah, well, one of the sort of side issues about at this conference is, yes, the good agents are doing that, but the association, both, all the local associations as well as at the state level, the California Association of Realtors, there is an acknowledgement that there's more training to be done among all the agents out there so that they're skilled at explaining this to buyers. Because you've got some agents out there who are not used to selling themselves. I'm talking about on the buyer's side, not very skilled at selling themselves and their services to their buyer because they've never been forced to, because their commission was already predetermined when they looked up the listing. And so the whole point of this settlement was to get away from, there should be no broker to broker conversation about what the commission is going to be to the buyer's agent. That should not and is not supposed to occur anymore. That's got to be a separate contract with the buyer and their agent. And then you got the listing contract and the listing agent. And then with those two contracts, negotiate the outcome. And in most cases, it's going to be fine.
That sounds great. Well, Art, I know that you are still live in Long Beach and you have sessions coming up. You've got to get back in there as a director. Any last thoughts before we let you go today? By the way, it's been a great show today and a lot of great information. Thank you.
Yeah, thank you, Jeff. Yeah, I enjoyed the conversation. Again, I can't say it enough. I don't want to sound like a broken record, but things are good right now in terms of the mortgage market, where rates are at. We're at a very normal level historically as far as mortgage rates. So I would say, if you have to talk to your therapist, let's see what you can do to get rid of the grumpiness about where the market is. Home prices are plateauing as well. There's a lot of things we can do on the incentive side in terms of financial concessions to help make those mortgage terms more palatable to you. So time to get off the sidelines, get in there, look around. We can help you find the home, finance in the right way. And so I can't urge that enough. And if you're thinking about a refi, now is the time. We've got good rate levels. They're plateaued. Don't wait around any longer. Any of these economic data points get any worse, it could hurt you. So I think it's call to action on both the refi side and the purchase side.
Yeah, that sounds great. Well, Art, thank you again. Make sure to call Art at his office, 760-969-5023. Or if you need to get a hold of him on his cell, it's 612-9035. You can always check out his website at mwloan.com, which he encourages. You can kind of get an idea, hey, what are the rate looks like? And then also there's a nice little tab on there down below about loans that is, he does a really great job of explaining about that. And then of course you can give him an email at art@mwloan.com. With that, Art, I'll let you go, and good luck with the rest of your conference, and we'll see you next week.
All right. Thanks, Jeff. See you later.
Bye-bye.
Okay.